Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of The Options Playbook. And welcome to another edition of Fundamental Fridays. So last week on Friday, we looked at NVIDIA and we explored, what option and what strike to buy. And inside the Trader.com paper trading portfolio, we looked at buying just at the money option contract, actually a little bit in the money, versus buying an out of the money option contract. We defined Delta without defining it. And we are going to come back and actually address Delta today. And we're going to look at those positions. Now, remember, if you open up, there's a link down below the video. If you click on it, open up an account, you can trade right along with me using the Trader.com paper trading app. All right, so let's take a quick little overview of, don't forget that options are risky. You should read the characteristics of risks of standardized options. Past performance is not a guarantee of future results. I'm going to be looking at some real stocks today, and it's not meant to be a recommendation. Okay, so here is just the general profit and loss graph. And I just tossed this in because we looked at buying a just in the money option contract, and I wanted to put a little bit more fodder behind what an at the money option contract is and how it moves over time. So if we have the stock at 60 and we have a 60 strike call option, in this instance, we were talking about a $3 option contract. We're going out 90 days to expiration, paying $3 for this option. And here is the profit and loss graph of the stock. And right in this instance, we're just looking at expiration, but the stock, you have unlimited upside. And we say substantial downside because it can only go to zero, but almost unlimited, right? When wherever you buy the stock at, that's your break even. That's where you cross your x-axis. If we buy the at the money option contract, we have limited and known downside to the premium paid, but we have unlimited upside all the way up until that expiration date. We can follow the movement of the stock on the way up. Now, here's the issue, though, is that options have a time component. So if you are buying an option contract and over time, the profit and loss graph changes quite a bit. Now, what I've done is I've taken the stock price. This doesn't say at expiration anymore, right? And here's our profit and loss on our long call option over time. If you have a 90-day option contract, the green line represents the profit and loss graph on day one. The brown line represents it on day 60. The red line is day 30, and then we get all the way down to expiration, being the blue line. Now, the moral to the story is here that you want to be right sooner than later. If I'm correct, the stock is at 60, remember, and the stock goes up, let's say 2 points right away, we make a lot more on that option contract if it does that 30 days later. And then if we go another 30 days, now we're actually up 2 on the stock and we're actually down on our option contract. And we talked about this in last week's show, that it's possible to buy options. And if you don't understand the dynamics of an options price, you could actually be right on direction and not right on, or you can be right on direction and not make money on your call option. And so understanding option pricing is really important. So I'm going to keep throwing little tidbits in as we go along this fundamental process on Fridays. Now, we did do a 4-part series, and if you do open up the paper trading account, or i.e. the account at Trader.com, we will send you out that 4-part series to you. It talks about, the vernacular of options, and we go into option pricing. Actually, I took this slide from that presentation, and then we get into the strategies. And then lastly, we talk a little bit about if you're just buying options, if you're buying a call, you're just buying a put, what strikes and what expirations you want to consider. Okay, so now I got one more slide that really kind of just emphasizes the movement over time of this option contract. And if you see, as right at 60, right, as this goes through time, every day that every day that the stock does not move, this is your decay graph. It's like that ice cube melting in the sun day in and day out. Now, you can show this many different ways, and that's one of the things that I always try to do with my education is I try to say things 2 or 3 different ways, because it might not click right with the first definition of time decay. So I always try to address that and look at it in different ways. And I really like the way that this the tracking of profit and loss graph over time, because this is a real options move at square at a time. I know that's an exciting concept, but it works. It actually happens as time decays. As we go through our time period, you see every single 30-day period, the line gets wider until that last 30 days. It's like, wham, my sled hit the tree, right? All that time decay has to happen. And if the stock's not moving, you're losing that time value. Okay, so how can we adjust that? Well, one of the things is think about buying in the money options. In our scenario, we looked at a just in the money and we looked at a not of the money, and we just wanted to make sure we spent the right capital inside our paper trading account at tradier.com. But here now I'm looking at a in the money option contract, and the break even changes quite a bit. I didn't draw the graph over time, but you can even just see by looking at the break even that if we buy and pay a little bit for our option contract, $6.30 here, as opposed to $3, now the stock's just got to get to 61.30 to break even. So intrinsic value is intrinsic value. The market, no matter how bad a market maker wants to not give you intrinsic value, it has to. There's no way that the options marketplace can function unless that intrinsic value is in the price of the option contract. And what I mean by that is the in the money amount. So if we're looking in this scenario where we have a 55 strike call, it's got to trade for $5. Why? Because I can exercise a stock, exercise and buy at 55. I can call the stock away from somebody, and then I can go out in the marketplace and sell it at 60, and hence making that $5. So that $5 has to stay in the options price. So no matter what, if I put this position on and the stock doesn't move, I'm getting $5, right? In the other scenario, I might not get anything if the stock just doesn't move and it stays at 60 the whole way through on an at the money option contract. All right, so with all that mentioned, I'm going to come back and I'm going to introduce you to Delta. But before we do that, we're going to take a little commercial break here and hear from our sponsor, Tradier. All right, we're back. All right, I'm going to start by defining Delta. And so let's run to the PowerPoint here. And we're going to talk about what the theoretical definition of Delta is, and then the non-textbook, the definition that I prefer. Once again, this is a slide that I took from one of the basic presentations, but Delta is a number that will help you develop realistic expectations as far as your option, how it should move relative to the stock price movement. Now, to me, that's just boring and it's not very helpful. What you really need to understand is how Delta moves, not only as the stock price moves, but you need to understand how it moves as we move through time. It's a very, very important concept, especially if you like to sell option contracts, but it is also important if you like to buy options. So we're going to start on the buy side because that's what we're talking about today is buying options. And so here's the textbook definition. Delta is the amount of theoretical options price will change for a corresponding 1 point. Well, they actually call it a unit. In most cases, it's going to be a point change in the price of the underlying security. So I've gone through this before, and if you've watched any of my other presentations, you'll know this slide fairly well. Stock is at 50. Stock goes from 50 to 51. We have a 50 strike 2-month call option. It's trading for $3. It goes from $3 to $3.50. Why? Because the delta was 50. Now, 50 is always truncated. It's 0.50. But all option, not all, 99% of all option contracts represent 100 shares of stock. So a lot of times people will just truncate it, and I don't want that to be confusing to you. And if you look at an option chain, you a lot of times will see that it says 0.50, but you multiply that by 100, and the delta is 50, right? Because it's representing one contract, and that contract represents 100 shares. That also means that if the stock goes up one, we make $50. We make $100 if we own 100 shares of stock, but on the option, we make 50. It's still a much higher percentage, but it's not on an absolute value as much as if you own the stock. And that makes sense when you think about options because they're a derivative. It's derived from the stock's price. You should never make more than something that it's derived from, right? So the maximum you can make is 1 because that's what you would make if you bought the stock. And this is a derivative. All right. Once again, saying it as many ways as I possibly can. Now, here's what's interesting about Delta is on our 2-month call option, the stock goes from 50 to 51, and now it goes from 51 to 52. Guess what? Delta increases. It goes from 50 cents to 60 cents. Once again, it's dynamic. So every dime that the underlying stock moves, the delta will change along the way. So it'll be a little bit more than 60. But in a theoretical learning world, let's just say it's 60. It goes from $3 to $3.50 on the 1 point movement. And then it goes from $3.50 to $4.10, 60 cents on the next point movement. And that's how Delta gives you realistic expectations. Now, this is, as of right now, this is in our graphic, this is day 60 on our profit and loss graph. Remember our little profit and loss graph we showed where we saw time decay over time relative to the price as expiration approached? Now, let's think about Delta and how it corresponds to a change in expiration. A lot of people talk about, well, an at-the-money delta is 50, and they just say it. Why is it 50? Well, it's because of the non-textbook definition, and this isn't 100% accurate, but all the traders on the trading floor use this definition, is that delta is the probability of the option being in the money on expiration. And everything has a delta. You talk to a trader and you say, hey, Joe, you want to go to lunch today? And he says, 50 delta, really busy. That means there's a 50% chance I might be able to go to lunch with you today. We don't know at this point in time. We got to see how the trading plays out, right? But everything has a delta. There's always a probability that's behind it. So delta is the probability of the option being in the money at expiration. So the stock is 50, strike is 50. Guess what the delta is? 50. Let's take it to an extreme. Let's not make this, and I didn't put a slide together for this, but let's say this is a 1 month call or a 1 day call option. 1 day to expiration. Stock is 50, strike is 50. We don't care what the price is. It doesn't really matter. But what's the delta? Stock is 50, strike is 50. And it's 1 day remaining to expiration. Stock is right at the money. What's the delta? What do you think? The delta's 50. You can't get more 50 than that. If you think about the delta is the probability of it being in the money on expiration, if it ticks up, if the stock ticks up a dime, it's in the money. It ticks down a dime, it's out of the money. You are as 50-50 as you can possibly get with 1 day remaining to expiration. But a better question is, let's say it moves $1 Once again, still, this is not a 2-month call. It's a 1-day to expiration. Stock is at 51. You have a 50 strike call with 1 day remaining to expiration. Now what's the delta? Well, if you think of the probability of it being in the money on expiration, the delta has just skyrocketed, right? So now at this point in time, the delta is 0.90. It's a 90 delta at this point in time. Why? Because the probability of it finishing at least 1 cent in the money on expiration is extremely high because the stock just made a very strong move, just moved $1. So the reason why I tell you this story is that there's always a trade-off. As expiration approaches, you have a large rate of time decay, right? And it gets bigger and bigger. The rate of decay gets faster, is the way I should say it, as expiration approaches. But also the delta does too. So if I'm long an option contract and I'm going to be right, and I buy the at-the-money option contract, I'd rather buy a shorter-term option contract because I pay a little less for it because I don't pay, but I get rewarded by a lot of delta. I get a lot of movement on that underlying. So once again, it comes in, if I'm buying out-of-the-money options, and I mentioned this in last week's show, I like to go out further in time because time is cheap relative the further you go out. But then as expiration, if I'm going to be correct on my forecast and I'm going to get in the money, I would rather have a shorter term option. So you have to balance delta versus time decay. And that's what we are looking at. And this is going to be a theme that we're going to talk about if we're looking at buying options. Now let's reverse the script and say we sold that option contract and expiration is approaching. Got this huge rate of time decay. That's a wonderful thing, right? Time decay is your best friend if you're selling options. But as expiration approaches, now it's getting close to getting in the money, and boom, all of a sudden it is, your delta skyrockets, and every single point that it moves against you, you lose $1 on all those points, or 90 cents in our case. All right. So that's the concept of delta. And if you have any questions on it, that's fine. But let's back out. And we're going to run over to the Trader Pro. Well, it's not Trader Pro, it's Trader.com. This is the web-based site. And we're going to look at our option contracts on NVIDIA. Okay, so we're scrolling up. We're on the dashboard. Now, this is a great example of NVIDIA, I guess, in general. We put this position on. Stock was at 217 last week. And I kind of like that we didn't really move that much. We bought this 1-day option contract. We bought one of those. And we're down 190 on that position. And on this position, we're down 105. So we bought, and just at the money call option, the 215, the stock was at 217. We were a smidge in the money, and we're seeing that time decay is really hurting us right here at this point in time. We got these out of the money option contracts. We paid here's our price. Price is where we're at. Value, cost basis over here. All right. So in this situation, we paid $12.75. We paid $4 for these, and it's at $3.65. We paid $12.75. We just bought one of these. We bought 4 of these. Our cost basis is $1,275. Our cost basis is $1,250. And over time, we're going to watch these positions and see how did the at the money option contract do relative to the out of the money option contract. We're going out to the August 21st expiration on this one. We're going out to the July 2nd expiration on the 215 call. And this shows you how time decay is working on the August versus the July. And we're seeing a higher rate of decay on the shorter term at the money option contract. So we're going to come back. We're going to watch this position. We're going to talk about delta. We're going to talk about time decay. And we specifically wanted to pay the same amount for both of these option contracts. Now, NVIDIA, this isn't a forecast on NVIDIA, right? NVIDIA is just one of the more popular stocks. like before we did a position on Apple around earnings. And NVIDIA and Apple are two of the biggest holdings inside the trade your brokerage firm by retail clients. And that usually happens. Anything that's in the Magnificent Seven or the Meg Seven is some of the most widely held stocks, just in general. So we are going to focus on those just because most people have a feel for that underlying. All right. And I do see a few good mornings. I appreciate it. Good morning, Kevin and Kurt. I appreciate you stopping in. If you have any questions, here's the biggest thing about Fundamental Fridays is that we want to make this available to you. Trader wants to make it available to you. They asked me to put some videos to go along with it. And every Friday, we're taking a little bit of a time out from skip strike butterflies and long call spreads. And we're going to address some of the basics of option trading in general. And we're going to say to you, open up an account. If you open up an account, you can trade right along with me and you can look at these positions. Now, other positions that you see in here, those are from Options Guide TV. Mondays and Wednesdays, we go in and we put on different trades inside the Tradier Pro software, and they actually show up here in our dashboard on Tradier.com too. But this paper trading account is free for all. You open up the account, that's all you got to do. You get free access to the paper trading app. All right, thanks for stopping in. We'll see you on Monday for the next edition of Options Guide TV. And then hopefully come back in for Fundamental Friday, hub.tradier.com, free sign-on, free for all, share with your friends, anybody that's interested in option trading. This is a great event that Tradier is happy to sponsor. Thanks for stopping in.